I love it when so many people show up on time. Here we go. We're going to go ahead and respect the time of everybody who showed up here. Thank you very much for attending this evening's webinar. Why don't I start off formally? Greetings. This is Ray Hightower. Thank you for attending today's webinar, What is Cost Segregation? Now, all of you in attendance are real estate investors. Many of you have heard about cost segregation and bonus depreciation, and you would like to know more. And as the year 2024 draws to a close, small and smart investors are asking, what is cost segregation? What is the relationship between cost seg and bonus depreciation? And as an investor, how can you benefit from these concepts? Today's guest is in an excellent position to answer these questions and more. Our presenter is Ms. Kim Lochridge. Kim Lochridge is Executive Vice President for Engineered Tax Services. Yes, she is an expert in cost segregation and bonus depreciation. She is an advisor trusted by Fortune 500 companies, high net worth individuals, ultra high net worth individuals, single and multiple family offices, architects, engineers, and CPAs nationwide. And more importantly, Kim Lochridge has personally invested in real estate since the 1990s. So she's not just a professional in an ivory tower. She understands the ivory tower stuff, yes. And as a person who has built her own portfolio, she is uniquely positioned to shine the light in this area. So, audience members, guests, please join me in welcoming our guest speaker for this webinar, Ms. Kim Lochridge. Welcome, Kim.
Thank you, Ray. Thank you so much for the kind introduction. I really appreciate it. And I appreciate you inviting me to be on the webcast today, because I think this is an important topic. So we're going to go ahead and start today. Just, I'll do a brief introduction about myself and my background and elaborate on what Ray had mentioned, as well as engineer tax services, so that I can earn the right to speak with you today. And, at the end, housekeeping, we do have a question and answer. So if you guys have some questions that you want us to answer, in many cases, I can do that in real time. So while we're on a specific slide, if you have a question about, something that pertains to you, we can answer those. If I don't answer it at the moment, that just means that's because I probably have a slide coming up. So just keep that in mind, and then I'll answer it at that point in time or reiterate the question. Today, we're going to talk about using cost segregation and how to harvest the tax savings. I think there's a lot of myths out there about cost seg, and about 15 years ago, I wrote an article that was titled Debunking the Myths of Cost Segregation. This is way before bonus depreciation ever became super popular. And so there are a lot of myths around cost segregation. Even CPAs don't really understand, in some cases, how to implement it into taxes, especially if they're not specialty in real estate. So without further ado, we're going to talk a little bit about the kind of the how, what, when, where, and why, okay, of cost segs. So to get started, just to elaborate a little bit, I am the Executive Vice President of Engineer Tax Services. I've been there for actually 17 years now. This is an old slide, but I have been investing in real estate since the late 90s, and it's been a ton of real estate, anything from cannabis warehouses to multifamily, short-term rentals, long-term rentals, a hostel, a gas station, mobile home parks, name it. There's a ton of real estate in the portfolio. I'm kind of known as a deal junkie. So I like the deals, and new property types don't really scare me, just because I think, once you're in real estate, you kind of understand the majority of it. I'm also on the tax and the sustainability committees for the Real Estate Roundtable in Washington, D.C. This group is very powerful. I'm very proud to be a part of this group, but just so you know, Real Estate Roundtable is the largest lobbying group in the country that fights for real estate owners and investors. So the statistics are that the members of that Real Estate Roundtable own 72% of all real estate in the country. So we're talking big REITs, family offices that just own huge portfolios of real estate, large and small, trophy buildings, big and little. So that being able to be in Capitol Hill every 3 months, to be able to be a part of those and to contribute on the committees for taxes is very important. I'm very proud of that. I also hold multiple board positions, and I'm a multinational speaker. So I've spoken all over the world about US taxes, and it's been such a privilege. So a little bit about Engineered Tax Services. We are a specialty tax firm. We do not file tax returns. We don't do your normal tax filings. So we will do the cost segregation studies that support the tax filings, also energy certifications and research and development tax credit studies. We won't really talk about much of that today. We're going to really focus on cost segregation so that we can get you a baseline and a foundation of what it is and how it applies to you. But Engineered Tax Services, we are nationwide. So we're actually based in West Palm Beach, Florida. So our team is hunkered down as we speak, getting ready for the hurricane, and should be hitting, if it hasn't already, very shortly. But we have multiple offices all across the country. Our engineers are strategically located to be at any property within a couple of hours. Okay, so we don't have to put anyone on a plane, and so that keeps our costs low. We have been in business since 2001, so this is 23 years we've been doing cost segregation. This is a long time. There's a lot of pop-up companies that are coming up and starting to jump on the cost segregation bandwagon because bonus depreciation really increased the need. But we've been doing this for a long time. We're kind of an OG here. And then just to give you an idea of the scope, we're running somewhere between 400 and 600 studies a month across the country. So that's a ton of real estate that we get to touch. It's very beneficial for us because we get to see trends in the market that other people can't see. We get to start seeing when there's, a shift in property type, when we really start to see the shift in multifamily. We started to see the shift in mobile home parks and self-storage, and kind of find that groove. So it is a very interesting opportunity to be on this side of it, where we get to see so much real estate and where it's going. Okay, so trends. So we're going to talk about what cost segregation is. All right, so cost segregation, backing up, when you buy property, an investment property, you have to depreciate that property over either 27 and a half or 39 years in accordance with the IRS. That's straight line depreciation. So, and through the course of this presentation, I'm going to use that 39 and 27 and a half years interchangeably. They're basically the same, except 27 and a half years is for multifamily or residential property. 39-year property is for commercial and or short-term rentals. So those of you that have short-term rentals, there is a special class life for that because the IRS looks at that as a hotel transient, which means that you have to depreciate that over the commercial class life, 39 years. I get that question a lot from people when I start delivering my returns or my results, and they say, shouldn't this be residential 27 and a half? But it's a short-term rental. So that's what's interesting, is that, essentially when you buy a property, say you buy a property for $1 million, and you have to depreciate that over 39 years, I think you're going to get about $25,000 a year in depreciation. I think it's 25,640 to be exact. But anyways, that is, every year you get to take $25,000 against the income. It's not a tax credit, it's a deduction. It reduces the income so that you don't have to pay as much in tax. And it's just a standard 39 years, you chunk away at the same deduction. Now, what's interesting is that our real estate pioneers have paved the way for us to do something different. And that's because of a series of court cases that date back to the 1940s. These court cases have established what we know today as cost segregation. So this is not a loophole. This is not anything new. It's not a shiny toy. This has been around for a very, very long time. And what they're saying is these pioneers would go and fight the IRS and say, I'm not going to depreciate my carpet over 39 years because it's never going to last that long. And so through the course of these generations, these court cases have established what we know today as our class lives for personal property. Okay, call it that. And that, let me see, the microphone's not working, but let me see if I can get that going. Okay, you guys can still hear me okay, Ray?
Yes, I can hear you.
Okay, great. So the transcribing might not be working, but at least you can hear me. Okay, so anyways, what happens is through the course of the engineers, the IRS says, okay, we will let you take a larger deduction or a faster depreciation if you have an engineer come to the property and certify and verify what assets were actually there and what the condition of those properties were. So when we do a cost segregation study, we can take the 39-year bucket. Let's say you still spent the $1 million, but now we get to carve out 5-year or 7-year or 15-year class lives. Typically for this, it's going to be 5 and 15 years is going to be the majority of what you're going to see. Okay, so 5 and 15-year buckets, but there are special buckets for other things too. So 5 and 15-year would be the buckets where, hey, we can put carpet in a 5-year bucket because it's probably not going to last more than 5 years. And that's what the IRS has dictated. Or say the landscaping, we can throw the landscaping, the driveways, the parking lots. We can put all that in a 15-year class life because chances are you're going to have to redo that in about 15 years. So what we do as engineers, we go in and we segment out the assets, hence the name cost segregation. We segregate out those assets, and then we value each asset, the carpet, the roof, the windows, the doors, all that, and then we apply the IRS pricing guide and put it into its appropriate bucket in accordance with the IRS regulations. So essentially what we're doing is we are breaking down, instead of depreciating the entire property over this long period of time, 39 and 27.5 years, we're now able to go in and segregate the assets in the property and put them in different buckets: fire protection, gas and distribution, the lighting, the electrical, specialty lighting, flooring, cabinetry, landscaping, name it, we pull it out. Okay, so the detail in these reports is unbelievable. And what it'll do, it'll break down not only the electrical, but it'll break out what special lighting. So let's say you have chandeliers or sconces on the wall versus standard can lighting, right? 2 different buckets. Specialty lighting or decorative lighting gets to go in a 5-year asset, and all of the electrical that services that outlet. So if you have the switch on the wall for that chandelier, and then all the electrical wire that goes from the chandelier all the way back to the breaker box, all of that asset gets to go into a 5-year property. It doesn't have to be depreciated over 39 years. Okay, so we can't just call it electrical because there's different types of electrical. So that's where the cost segregation comes in. So there's a couple questions of why we would do something like this. And I think you're probably getting to it, but accelerated depreciation, obviously. If you value your carpet at $30,000 and you have to depreciate that over 39 years, you're not going to get much depreciation on that. But if you can depreciate that $30,000 over 5 years, then now we're starting to talk that we're getting more depreciation up front. And that's what accelerated depreciation is. It's not really accelerating it other than it's reclassifying it. So we're reclassifying those long-term assets into shorter. Now, the other reason why we would do this, and this is, I think, very, very important, is that the IRS writes a guide. It's called the ATG, or for that's short for Audit Technique Guideline. This is a guideline that the IRS writes for their auditors so that they can go out and properly audit a return that has what in it? Cost segregation. The audit technique guidelines are written for lots of different things, but there is one specifically for cost segregation. And in that audit technique guideline, the IRS states that the maker's methodology, which is the methodology of what we're doing, we're shifting it from straight line depreciation to this maker's methodology. It's MACRS is the acronym for the tax term. But cost segregation is what that maker's is. And in that audit technique guideline, the IRS tells us that the maker's methodology, or this cost segregation, is the preferred method of depreciation. Now I sit there and think to myself, like, why would they say it's the preferred method? And the reason is because when you do a cost segregation study, and let me give you an example. Let's say you buy a property and it's 20 years old already, and it has the original roof on it. And then you come into that property in year 5, you buy it, it's new to you, right? So you start depreciating it, but from the purchase price. But then in year 5, you have to put on a new roof. Well, you're depreciating that roof over here in the original purchase price because your property had a roof when you bought it, right? And so then you put on another roof in year 5. Well, the IRS says you have to capitalize that over 39 years or 27 and a half. So now when you depreciate that and you capitalize it on the depreciation schedule and you already have this one, now you're depreciating 2 roofs, one of which doesn't even exist anymore. So think about that for a minute. If you've done a cost segregation study and we've valued your old roof, now you have another tool to calculate what's called partial asset disposition. Partial asset disposition is just that. It's the disposal of part of your asset. So when you go in and you take off that old roof and you have had a cost segregation and you valued that roof and you have 22 and a half years left of depreciation on that roof, guess what? As soon as you put the new roof on the depreciation schedule, you're going to take the remaining depreciation from the first roof and you get to write it off as an expense. That's called partial asset disposition. That is a secret that a lot of people don't know about. As a result of doing a cost seg, you can also take this partial asset disposition. So it optimizes your annual write-offs. If you go into a property and you do value add or CapEx and you're refreshing units and you're putting on a new roof and you put in new windows and you put in a new dog park and you put in a new parking lot, all of these things that you're doing to the property to make it better so that you can increase rents, so that you can then have a better return on investment. Well, having a cost seg study done is imperative, isn't it? So for this reason, this is why the IRS says that this maker's methodology is the preferred method, because when you have those cost seg numbers and you can take off the old roof, now you're only depreciating one roof, and that is more accurate to what's really going on in the property, not depreciating 2 roofs. Okay. So that's why the IRS says that. So another reason why this is beneficial is obviously for the write-offs. Obviously, we can also add to that repairs and routine maintenance and those types of things. The retirement of the assets or the demolition is what that partial asset disposition is. So there's one more reason why cost segregation is so powerful, as if that's not powerful enough, right? So those things are pretty cool. But now we have bonus depreciation. Bonus depreciation is very, very interesting. So do you remember when I told you that we were transferring some of these assets from a 39-year class life into these 5 and 15-year buckets? So that's all great, but what happens is you are now, as you reclassify those assets into buckets, 20 years or less, okay? So any property that has a class life of 20 years or less, you can now apply bonus depreciation, all right? So a lot of people think that cost segregation is bonus depreciation or bonus depreciation is cost seg. They're 2 separate things. Bonus depreciation is a result of doing a cost segregation study. You kind of have to do the cost seg in order to be eligible for the bonus. In these cases, in the purchase, right? So in this case, now here's another myth. A lot of people think that bonus depreciation started in 2017. It did not. Actually, bonus depreciation started in 2006. However, back in 2006, it was really only for new construction, so new money spent, new construction or improvements that you would put into a property, and it was only 50%. So we had 50% bonus depreciation for new construction or improvements, all right? But bonus depreciation was not eligible for acquisitions or step up in basis or 1031 exchanges or anything like that. And so when the Tax Cuts and Jobs Act came out, we were given an expansion of the bonus depreciation, which Trump says now you can use bonus depreciation for acquired property or purchases, okay? And he raised it to 100% instead of just 50, okay? So what does this mean? What this means is that the 100% bonus depreciation will make this easy math. If we're able to reclassify a 5-year property or 15-year property from 39, right, we're reallocating it from 39 to the smaller buckets. If it's less than 20 years, the IRS says normally, if it's a 5-year bucket, you have to depreciate that over 5 years, right? Pretty common sense. If it's 15, it's 15 years, right? You depreciate that over that period of time. But bonus depreciation actually kicks in, and they say, you know, if you have 100% bonus depreciation, you don't have to wait 5 years for the depreciation. You get 100% of that 5-year bucket up front. Okay, 15 years, same thing. Anything with a class life of 20 years or less. So if you buy a vehicle through your company, that vehicle, you can put it into a 7-year bucket and depreciate that. So if you bought that between 2017 and 2022, you could have taken an entire write-off on a brand new $70,000 truck. Okay, so that was bonus depreciation. Now, bonus depreciation is starting to sunset. What that means is in the Tax Cuts and Jobs Act, it's stated, but way back then in 2016 when we got it, that starting in 17, we're going to have this through 2022 at 100%. So if you buy a property and you do a cost seg study, we can allocate the 5 and 15-year buckets. You get it all right now. Take the depreciation. In 2023, now bonus depreciation is triggered by the placed in service date, not when you do the cost segregation study. So the placed in service date, when it became eligible for rental, that is your trigger date for the bonus depreciation percentages. So if you bought it in 2023, now we have bonus depreciation at 80%. And then this year is 24, which is 60%. Then next year is 40, 20, and then it's gone in 2027. The significance to this is that essentially right now you get to take 60% of that 5 and 15-year bucket up front. The other 40% is still in the 5 and 15-year bucket. So those get spread out over their respective 5 and 15-year buckets. Okay. So that's kind of how bonus depreciation works. And I think it's important to describe that because it gets lost. People don't really understand how bonus depreciation works or when. So there was a bill that would increase the sunsetting bonus depreciation back to 100%. Being on the tax committee, that was a huge, discussion point. It did not pass the Senate. It passed the House, didn't pass the Senate. And that's only because it was coupled and bundled with a controversial child tax credit. So because of the child tax credit, and we won't go into the details as to why, it's a little political, but just so you know, the bonus depreciation doesn't matter who is the president, doesn't matter what regime we have in place, whether it's Democratic or Republican, because bonus depreciation, since it's been around since 2006, it has gone through both Republican and Democratic parties. It is bipartisan. So if this comes back, it doesn't matter who the president is, it will likely be reinstated. In fact, its bipartisan support is stating that we want the 100% bonus depreciation come back. So after the election, we're going to see a tax bill, usually in January or February, that will probably pass, and we'll get the 100% back. And it will likely be retroactive. So if you've done a cost seg study on a property that was placed in service in 2023 and you only got the 80%, you can go back and just reclaim that extra 20% if it passes. Okay, so keep your eye on that. Let me know if you guys have any questions as that comes up. So let's go and talk about kind of some good candidates for cost segregation. Okay, so good candidates for cost seg. If you are the owner of any commercial or investment property, this could be residential, commercial, like I said, short-term rental, long-term rental, as long as it's income producing, you can do a cost seg study. It doesn't really matter whether you're passive or active or if you have real estate professional status or not. And I'll explain that in another slide. But it's just different treatment, and it falls on your taxes in a different way. But if you have an investment property, so if you're on this call and you are a partner in a syndication, you want to make sure that the syndicators are actually doing cost segregation, because that can flow down to you personally through losses, even though you might be getting some distributions. So make sure that you're asking those questions when you're investing your money. Be smart. Ask them if they're doing cost segregation. We know Ray is, right? So also, if you are the owner of leasehold improvements, let's say you're a dentist and you move into a strip mall and you don't own the building, but you put in $500,000 worth of improvements, you can do a cost-seg study on that, okay? Because you own the asset. And we can do any improvements of $50,000 or more. So that actually is a pretty small basis. And it still makes sense. So any owner who's paying federal or state tax, great opportunity on the real estate to do a cost-seg study. Obviously, you need to be for profit. So if you are, you know, a 501c3 foundation or something, you own a property, it's probably not going to be a good fit for you because you don't pay tax anyway. So this is a tax deduction. Remember, you have to be paying tax in order to get it. And then any owners who are holding an investment property for more than a year. So less than a year would probably be considered a flip, right? Which it's not going to be a good candidate for a flip. Why? Because when you do a flip, you buy the property, you renovate the property, and then you sell the property. Typically, it never hits the depreciation schedule because it's never technically in service, and then you sell it. So that would not be a good candidate. But anyone else who's holding a property for more than a year would be a good candidate for cost segregation. Now, we have a motto at ETS, and this is on my business card. I live and breathe this every day. And the motto is everyone should pay tax, but there is nothing in the code that says you have to leave a tip. So we are in the business of taking the tip off the table. We don't want to give the IRS any more money than we have to. If these tax laws are available to us, we want to use them. Again, this is not a loophole. This is not a fad, right? Cost segregation has been around since the 1940s. So this is not new, even though this might be new to you, okay? So let's talk about what types of properties would benefit, all right? So newly constructed properties, great opportunity. Even though you might have an AIA document that breaks things down, obviously you're not going to be able to tell on that AIA document what was specialty electrical and what was standard electrical. That's where we'll break that down even further. But the new construction is very beneficial. Renovation. If you're doing any kind of CapEx or renovation to the property, we want to make sure that you get in and do a cost-seg study first before the renovations is always ideal, not necessary, but ideal, because then we can set the baseline for the IRS and prove to them what was there at the time of purchase. And then the renovation and the improvements get layered on top of those benefits. Okay. So now you're establishing not only your baseline for the original purchase, but then you also do the improvements. And remember, when we talked about those improvements, we calculate the partial asset disposition. So we're going to calculate the removal of the assets when you put in the new ones. Okay. Great opportunity to do a cost seg. Existing properties. So if you have properties that you have purchased 5 years ago that's income producing and you're just now learning about cost seg, we can go back and we do not have to file an amended return. We can, the IRS gives us the ability to do a, it's called a Form 3115. It's a tax form, but essentially it's a reconciliation between the old depreciation and the new. It's the same exact form you would file if you're filing a cash basis and you convert over to a accrual basis, because that's exactly all we're doing. We're shifting the depreciation from a methodology of straight line depreciation, we're moving it over to the makers. As a result of that, you have excess depreciation that you need to take. It gets reported on this Form 3115, okay? So it's really easy to do. You just need to get the study done, and then that form, you can either have us do it or your CPA can do it, but that Form 3115 will prevent you from having to go back and file an amended return, which is nice, because 5 years ago, you wouldn't be able to file an amended return, only 3 years. So other properties that benefit would be recent or new acquisitions, purchases, right? So anytime you purchase a new property, we need to do a cost seg. And leasehold improvements, we've already talked about that. So those would work. How about a step up in basis? So let's say you have a partner and you buy the partner out. You're going to have a step up in basis to the fair market value. That excess basis, we then want to apply the cost segregation to. Or if you have an inheritance. Now, we have to remember that this generation right now, this is the biggest wealth transfer in history going on right now. As our baby boomers start to pass away, the largest wealth transfer is happening right now. And when you have an inheritance of that property or that real estate, you've got a fair market value step up in basis. And that's when we can offset some of those estate tax with a cost segregation study. Okay. And then the other property that if you do a 1031 exchange, if you're selling a property and you roll those gains over into the new property, we can do a cost seg study on the excess basis. Okay, so the extra basis above and beyond what your gain is that you brought in. All right. So I'm going to go over just a few more slides and then I'm going to open it up to some questions. So you guys get your fingers ready and start asking some questions. I know you have some, hopefully, to answer. Now, this slide is one of my slides that I use for the myth. I cannot tell you how many times I have CPAs that will tell me or tell the client, oh, you don't want to do a cost segregation because if you take all the depreciation up front, you're not going to have any more depreciation in future years when your income gets higher. Okay, first of all, let me just prove to you why that is so wrong. So the yellow line is your straight line depreciation. This is your $25,640 every year for 39 years. Blah. Oh, that's terrible. Like, please don't ever do that. And then the blue line is actually with the cost seg. So you're going to take this huge benefit. So if your first year, if your yearly deductions are 100,000 and you do a cost seg, you can get 600,000 the first year spread out over 5 years. And then it drops, but here's what's important. It drops just a little bit below the line of what the straight line depreciation would be. It's not zero, it's just a little bit less. But you got to take this huge deduction up front. And then again in year 16, you take a little bit less because your 15 year now starts to scale down. And it's just a little bit. It's not zero. You still have depreciation. And I'm going to show this to you in some numbers on the next slide. But remember this because this is exactly what happens. Now, let me just give you I love analogies. One thing that I'll tell you is that cost segregation, if you're going to file your taxes, you have a choice. You can file a 1040 easy and you can take your standard deductions, or you can file a 1040. Now, and you take your itemized deductions. And usually those of us who file a 1040, we have to go to a CPA and we pay them to prepare our taxes for us and they itemize them. And those CPAs are usually worth their weight in gold, right? Because they know the tax laws and they know what you can take and what you can't take. Cost segregation is exactly the same thing, but for your building. Instead of taking your standard depreciation under straight line, all you're doing is filing an itemized depreciation study for your building. So you're itemizing. That's it. That's the only difference. Okay, so no different. Both are legal. You can use the 1040Z, you can use the 1040. The IRS doesn't really care. I mean, there are some parameters, but in many cases. So that's what we're doing here is we're just shifting it. We're just choosing to itemize our depreciation in the building. Okay, it's as simple as that. Now, on the next slide, this is an example. Now, this is a small property, okay? This was probably a short-term rental or something. They purchased it for $500,000. And I just wanted to show you with a short one, a small one, so that you can see the benefits that I'm talking about. In this particular case, this was purchased in 2023. So the bonus depreciation was 80%, okay? So 80%, and we pulled out 30% for land because that was a non-depreciable. I think this is a California property. And so with those benefits, this column B right here shows this was purchased on the last day of the year. And so because your depreciation on straight line is prorated, the first year without cost segregation, they would have gotten $387 in depreciation because it was only in place for 1 day. And every year after that, they would get $92.97. So basically $9,300 in depreciation for 39 years, okay? Well, with this example, because we did a cost segregation study, the column C shows that their first year depreciation was $76,000, over $387. Okay, so now this client was able to take a $76,000 tax deduction, even though they only owned it for 1 day. This is so powerful, you guys. That property is placed in service. Bonus depreciation is eligible. Remember what I said. If you reclassify the property and you apply bonus depreciation, you get it all right now. You don't have to prorate it. You get it right now. So the first year they got 76,000, the second year 12,000, the third year 10,000. Look at this. Here's where it drops just a little bit below the number, below where it would have been had you not done this. But look how much more depreciation you got in the first 4 years. And even down here in the very bottom where we hit the 16-year mark, just a little bit lower. So you're really only losing $2,000 of depreciation a year with this particular property, but look at all the deductions you got up front. Okay. So this is the power of cost seg. Do you know what you can do with the $76,000 tax deduction? I mean, let's just say you're in California, that's a $35,000 savings of tax. Okay. So $35,000 went into my pocket. I got to put a down payment on another property, or I got to improve something, and I didn't have to give that money to the IRS. Okay. Now, another myth that I hear all the time from CPAs is like this time value of money. Yeah, you know, you're going to get it all right now, but it's the same value. It's the same money over 39 years. So who cares? Well, it cares a lot to me because I'm an investor. And anyone who says that the time value of money, it's the same money whether you get it now or in 39 years, hogwash. I would never think that way as an investor. But yet CPAs tell people that all the time, do they not? And so essentially the power of what you can do with this right now is where we want to see those benefits. We want to see what we can do with that. The reason the IRS allows us to do this is because the bonus depreciation is a tool that the government turns on and off to increase the GDP or to incentivize us to what? Spend more money. So if we're saving $35,000, guess what? You're probably going to go spend $35,000 somewhere else in your local community, or hire somebody to do some jobs for you, or buy another property. What do you think that does for the economy? So this is a tool they use, and this is why this is bipartisan. It doesn't matter what side, okay? This is some detail. If you look really close at this is just the 5-year asset. This is one page of 50. That is the breakout of the equipment panels, the detail, the lineal footage, the total depreciable basis of that asset. So you remember when I said we value each asset? I'm not kidding. Every sconce on the wall, every elbow behind the plumbing of the wall, like the light switch plate covers on the wall, for crying out loud, everything is broken down and counted with the unit and the total depreciable basis. So when you're doing improvements, you can go back to your report and just highlight the things that were removed, and then you can do the calculation and write it off. Okay, partial asset disposition. Super powerful. Okay, so just a couple more slides. Actually, this is my last slide, and then we'll open it up to questions. So let's talk about the deductions. Okay, the deductions are very, very important. There are 3 levels of how a cost segregation can flow through your tax return. So you have real estate professional status, all right? So those of you who are syndicators, that's your full-time job. You work in real estate, you invest in real estate, you manage real estate, yada, yada, list goes on. You are classified as a real estate professional. And what that means is that $76,000 that we just saw in that last cost seg study, that means that $76,000 comes into your personal tax return and offsets $76,000 worth of income. Can you imagine if that was a $10 million property or $13 million property, right? Start exponentially doing the math, right? That's a huge value. Now, I will tell you about full disclosure personally. I told you that I'm a real estate investor. I've been investing in real estate for 30 plus years. I've been investing in real estate longer than I've had my husband. So my husband comes in about 10 years ago, and I just begged him, like, quit your job. Like, quit your job, become a real estate professional, manage all of our real estate so I can get back to work. It took me 8 years to get him to retire, but he finally retired. He retired when he was 50 years old. And we now have him as our real estate professional in the family. Now, what happens is as we invest in real estate, actually, I invest in real estate. I'm the deal junkie. He manages them, but I'm the deal junkie. So I go buy them. and then all of those deductions come through. And he is the real estate professional. 750 hours a year is what's required. He doesn't have a real estate license. It doesn't matter, but he is classified as that's what he does, his full-time job. So that those deductions that we bring in offset my W-2 income because we are married filing jointly. So the real estate professional status can be extremely powerful. I will tell you that, well, I'm not going to tell you what my tax rate is, but it's very low, my tax percentage. Okay, so we won't say it out loud because this is being recorded and God knows we don't need that to be advertised. But yeah, so material participation, I won't spend too much time on this. Material participation is the same treatment as real estate professional status, but different requirements. Real estate professional status, you have to have the 750 hours of active management. Material participation is for short-term rentals. If you have a short-term rental, now let me just explain this real quick. Let's say you're a doctor, you have high income, your wife stays at home. You turn your wife into the real estate professional and you go buy a bunch of short-term rentals. Those short-term rental, well, even if she could be real estate professional, that's 750, but short-term rental material participation is only 100 hours. It's like 2 hours a week. That if that spouse invests 2 hours a week on a short-term rental, manage them themselves, those deductions flow through and offset the W-2 of the doctor. Okay, so this is why you're seeing a ton of short-term rentals coming on the market, because there is a huge tax benefit to short-term rentals on that material participation. And you can actually be two income earners. You can have two W-2 incomes and still own short-term rentals and take a deduction as active against your W-2 income. Hugely beneficial. Okay. Now, the last bucket is a passive investor. A passive investor is somebody who might invest in a syndication, but they have a full-time job. So they have a full-time job that's not in real estate. Maybe they're in a doctor, or maybe they're in IT. Okay. So they're a passive investor in real estate, which means that if the syndicator does a cost seg study and flows through those deductions after they've done a cost seg study, that those losses flow through to them on a K1. So even though you're getting distributions, you're getting payments every month or every quarter from that investment, you're getting delivered a negative K1 in many cases. So don't be surprised if you get a K1 that has a negative balance on it, even though you got distributions. It's not wrong. It's because the syndicator did a cost segregation study. So here's where this gets really, really interesting. When you're a passive investor, you know, chances are you're not only investing in one deal. Chances are you've got a lot of other investments that you have, okay? So let's say that those are all passive investments. Then you have a cost seg study come through with all this negative balance. If you group those passive activities together, the losses from the cost seg study can help offset the income from other passive investments. So if you're a syndicator, don't think for 2 seconds, oh, you know, this won't be beneficial for my investors because they are passive and it won't matter to them. Well, guess what? Chances are you're not the only game in town. You're not the only person they're investing with, right? So they have other investments that they could probably use that and you'd be doing them a huge favor. So that's why I say that even though you're a passive investor, let's just say, forget the syndication. Let's just say you passively invest in a long-term rental, okay? And you have multiple long-term rentals. You can still do a cost seg study and it offsets the income from those rentals. So essentially you're getting all the rent payments, but you're not paying tax on the rent payments because you have this excess loss, okay? Now, one other thing I'm going to talk about, because I know this is going to come up in questions, is recapture. If you sell the property, this is another myth. The CPAs will tell you, oh, if you sell that property, you're going to have to pay it all back. Not true. So first of all, it is prorated. So it depends on how long you've owned it. It's like getting a job and telling your boss, pay me 5 years up front, and then you quit your job in year 3. You quit your job in year 3, well, you've been paid for 5 years, so you're going to have to pay back the other 2 years. That's recapture. Okay, so if you take this property and you take the bonus depreciation and you get this 5-year and 15-year bucket up front, then you sell the property in year 5. 5 years already done and fully depreciated, so you're fine there, but 15-year, you've only depreciated a third, we've only had it for a third of the time. So you do have to pay that back. But here's the kicker. When you do a cost seg study, you get the deductions off of your ordinary tax rates, your highest tax bracket. When you sell the property, you pay capital gains rates, which is less. So therefore, you automatically have a 10 to 15% arbitrage in your favor. So essentially, you just got a loan from the IRS and they paid you 10 to 15% to take it. So when you do have to give some of it back, okay, give some of it back, but you got to use that money for how long? How long did you get to use that churn and burn and reinvest and redo that money? How important is that? So the recapture is, yes, it's a factor, but really be careful. This is why I say if you've owned the property more than a year, you're going to want to do a cost seg study because you can always use that as a tax strategy. Let's say you buy it in year 1 and you sell it in year 3. You've just had a loan from the IRS for 2 years and it's so you pay it back at a reduced rate. Who wouldn't do that? I mean, we're out there getting loans all the time, right? Who wouldn't use this tool? So I use it every day, every single day. I live and breathe this, not only in with my clients, but in my personal portfolio. And I would never buy a property and not do a cost seg. I'll just say that right now. So I'm going to put my contact information on the screen. If you have rental property, please call me. I would love to work with you on your cost seg study and show you how this works in real life. And I think we might have some questions that we can open it up. And I'm fine, Ray, if you want to unmute people or if
Oh,
they have.
yeah. We do have a few questions. First, Kim, thank you for sharing everything that you shared with us tonight. This is wonderful. I'll tell you that quote that really jumped out at me. How did you say it? Everyone should pay tax, but there is nothing in the code that says you have to leave a tip. So I think that resonates with a lot of the people that are here on our webinar this evening. So that's wonderful. Here are a few questions that we have that have come up. And if anyone else has questions, please feel free to put them in the Q&A there in Zoom. You'll see the Q&A button towards the bottom of your screen, towards the bottom of your Zoom screen. But to kick things off, first question we have is, if an investor wants to get a cost seg study done, what do they need to give your ETS team in order to get started?
Yeah, that's a great question. So it's probably less than you think it is. If it's just a straight purchase, really the only thing we absolutely have to have is the settlement statement. We will ask for the appraisal. We don't care what the appraised value is because that's not what we're using it for. We're using it for the narratives and the property and the square footage and all that good stuff about the age and demographics. So settlement statement and appraisal would be great. But if you haven't purchased the property yet, you can just send me the purchase price, the address, and the date that you intend to close. I can do some preliminary numbers for you. If you do improvements, we're going to need a cost breakdown of those improvements, a place and service date, like when did it actually go into service. Yeah, but that's really that's only what's mandatory. We will be asking for things like a site survey if you have one. It's very helpful for us to see the footprint of the lot for the landscaping portion of it. It's helpful for us if this has been in service for a few years, get us the depreciation schedule so that we can match it up exactly to your schedule. Your CPA will appreciate that. But yeah, it's really pretty painless, to be honest with you. We do an in-person site visit. And the in-person site visits are very important because I think I had mentioned earlier that there are some companies out there who do virtual site visits and some that don't even do site visits at all. There's this DIY, place online, but the IRS has been very, very clear that there has to be an in-person site visit by a building professional. So some of these companies that are popping up, they're sending a photographer just to kind of get pictures and prove that somebody was there, but they can't do counts. How are they going to determine what is a specialty lighting versus standard lighting? Okay, so there's a lot of definitions that you need to understand really what that means. So inspectors or engineers or somebody who is a contractor, someone who's a building professional that understands that stuff has to be on site. If you don't have an in-person site visit, or if you don't have a qualified in-person site visit, the IRS has been very vocal about the fact that they will literally just throw out the cost seg. So they
Mm.
will ask for the report and they will see who verified and what their credentials are. And if they don't meet the credentials, they won't allow it. So they're not going to go do the cost seg for you. They're just going to throw it out and you'll have to do it again. So just beware, people who are coming into this business that haven't learned the hard way. We've been doing this for 23 years, as I mentioned.
Mhm.
We are very, very close to the IRS. We devour those audit technique guidelines so that we understand the intent of the IRS and we're not trying to cut corners. We're going to do it right. And we're going to do it right the first time. So that's the most important thing. And my best piece of advice is just to make sure that it's, you get what you pay for.
Okay, you get what you pay for. Yes, and as you said, you've been doing it for 23 years and have gone through some challenges, and as a result, your muscles are strong. So that's great. That's great. Another question that has come up. I didn't quite understand how there is depreciation left after the cost seg. What are the items that are still depreciating after the 15-year bucket?
Yeah, that is a great question. And I probably could modify the slides just a little bit because of that. So it's not all of the assets that are classified into 5 and 15 year. Typically, depending on the property type, it's like 30% of them. So basically what we're going to do is we'll take 25% of the assets from that building are going to go into a 5-year bucket. Maybe 10 to 15% are going to go into a 15-year bucket. Okay, so part of the building. But the things that are left in the long-term asset, the 27.5 and 39-year, are all structural. Your walls, your roof, your windows, your doors, your foundation, utilities under the ground, standard lighting, standard plumbing, things like that that are a must for the building have to stay in that long-term asset. So that's going to continue to depreciate after
Mm.
your 5 and 15-year buckets are extracted. Okay, so that's how it works is we pull out a portion to go 15, a portion to go 5. Those qualify for bonus, and then the long-term assets don't qualify for bonus. So you actually continue to straight line depreciation the leftover assets after we extract the 5 and 15-year buckets. So hopefully that cleared up that question.
Okay, got it. And if you want to ask a follow-on, anyone who ask a question, anyone who poses a question, feel free to ask a follow-on because we want to get as much of this out there as we can. And also, Kim's contact information is right here, so you can certainly reach out to her if you have something that is very specific to your situation. A few more
Guys,
questions.
this is
Oh,
my
go ahead.
cell phone number. So just you so you know, that is my cell phone. That's my personal cell phone.
Oh, yeah,
So
yeah.
email would be best, especially it's 10:15 deadline, so we're still trying to get studies out the door for people who are late filers. But just be respectful if you would. I don't mind giving out my cell phone, and you can feel free to call me or text me. But if just so you know, that is my personal cell phone, and I'm willing
Right.
to give it out, but be respectful.
Yeah, yeah. Well, we are grateful to you for sharing that with us, and I'm confident that the kinds of people who are here on this webinar will be respectful of your time. So that's what we do for each other. We treat each other like professionals, and we respect each other's time. Another question. I didn't hear you explain the 3-year and 7-year buckets. Can you explain?
Yeah, so 3 and 7-year buckets are special, usually for manufacturing. So like equipment. So if you have a manufacturing facility and you're buying a bunch of equipment and you put it in there, you can depreciate that over 7 years. And there's a very special bucket for 3 years. So they're really not going to be anything that's in your traditional real estate holdings. Those are special buckets. They're rarely ever used.
Okay. Special buckets for manufacturing equipment. Got it. All
Yeah.
right. All
And
right.
other things, like a 7-year bucket would be a vehicle, like a company truck or
Yes.
car. Things like that go into a 7-year bucket, but they're not usually related to the personal property or the improvements of a real estate property, like unless it's manufacturing.
Got it. I love the way you seem to have the tax code in your head. When you were answering that, you were like looking up in your head, almost as if you were looking inside of your brain at the pages you've memorized after being in the business for so many years. That's very cool.
Yeah, it's been
Um,
a long time.
How much time, here's another like kind of a follow-up for an earlier question. How much time does the ETS team need to spend on site for the cost seg study? You mentioned that you absolutely do need to do a site visit. How
Yeah.
much time do you need, and how many units do you need to get into? As a syndicator, as an owner, I'm always sensitive to, disturbing residents and all that jazz.
Yeah, great. Another great question. So it's like an appraisal. So if you have like a single family home or something like that, it's going to be like an hour, hour and a half, 2 hours maybe, inside the
Yes.
property, outside the property, tons of pictures, videos, that kind of stuff to document. A larger property with units, we like to try to get into at least one of every floor plan. If you've done renovations on half and not others, we want to see an old one and a new one, if they're
Yes.
different. But typically we get a rent roll. We will ask for a rent roll so we can see how many of each unit you have, like 3 bedroom, 1 bath, 2 bedroom, 2 bath, whatever. And then we'll usually say, can we get into one of these, one of these, one of these? And so that's what we do there.
Got
But
it.
it really is, it's very similar to the time that it would take for an appraisal. It's not
Okay.
days or anything like that.
So you're doing a representative sample of the units, not like what we do during due diligence, where we go into every unit and gather info. You need a representative sample of the units.
Yeah, just the sampling, because then we can duplicate that. We have a pretty good idea of what's in the property. So,
Okay,
yeah,
wonderful.
yeah.
Okay, there's two more have come up. Oh, here's one from one of my favorite CPAs, Justin Jensen, has effusive praise for you, Kim Lochridge, and nicely done, Kim. So thank you
Hi,
for that,
Justin.
Justin. Justin's awesome. So
Thank
there's
you.
I
Hi,
think we can,
Justin. How are you? I'm so glad you're here.
yeah. Glad that you're here. Wonderful.
Nice.
Next question: what is the cost for this service? From
Yeah,
anonymous
that's
attendee.
always that's always a good question too. I hate it when people give me vague answers, but I have to give you a vague answer on this one. Because I will tell you that our pricing is determined by three different pieces of criteria. One is the property location, because a property labor in California is a little bit higher than labor in Ohio. Okay, so that's going to be different. So property location, property type. So like a medical office building is going to have a ton more electrical, mechanical, and plumbing than say a warehouse. Okay, so the type of property is also very important because when we do our cost seg study, we actually rebuild the building in whole from the ground up using construction software. That's how we get all that detail. Every single elbow behind the wall and everything is broken out. So when you have a property like a multifamily or even medical office space, it's a lot more elaborate than maybe a warehouse with concrete floors and shelving. It's going to take us a little bit more time, so we charge more for that. And the third piece is the square footage. So if you have a single family home that's 2,000 square feet versus a 150,000 square foot apartment complex, obviously that's going to take us a lot longer. So I will tell you though that a single family, do not hold me to this, but like a single family home, which we do a ton of rentals, is going to be roughly $3,000, give or take a couple $100. Okay.
Mm-hmm.
But it's well worth it. I promise you that. And our fees are tax deductible. And you work your way all the way up to like larger, facilities. I would say on average, commercial properties are going to be somewhere between 5 and 10,000, depending on the size and the location. And then we get up into like trophy buildings, like I've done huge like W hotels and trophy buildings in Atlanta or Chicago, big 40, 50 story buildings. I mean, those are going to run, probably 50, $60,000. So it's not everyone's game, but that's
Mm-hmm.
kind of the range. It really just depends on how long it's going to take us. It's not contingent upon the benefits. It's
Mm-hmm.
just a flat engineering fee. Okay. And we'll
Yeah.
price that out once we get the addresses.
It's a flat engineering fee, and it sounds like the return on investment is solid. Like wherever that fee is, you're going to get corresponding benefits that will certainly justify that.
Yeah, if your returns aren't a 10 times multiple, I usually don't recommend it. I mean,
Okay.
unless you're trying to solve a problem. I mean, that's, where else can you get a 10-time multiple?
You know what? That's a perfect place to end the webinar. We want to make sure we respect everyone's time. We're at the top of the hour. Kim Lochridge, thank you for being with us this evening to answer questions about cost seg and bonus depreciation. And if anyone wants to get in touch with you, they can reach you via engineeredtaxservices.com. Thank you,
Yes.
Kim.
Thank you so much for having me. You guys have a great night.
Oh, and I should mention, all of you who attended, make sure you talk to the person who invited you if you have questions about how you can apply this info to properties that you're investing in. So have a very good evening.